Hey everyone, I'm Mark Goucher and welcome to another video of Simplicity Investment Watch. Today is Monday, January 13th, 2025. As I do this right now, the markets are already open. It's early morning. Oh, well, it's after 9:30. Obviously, the markets start open at 9:30, but markets are open. Last week, the major markets, they took a beating flat out. It's a risk-off trading environment. The overall downtrend from the recent highs are running in the 5 to 6% range off of that high, um, and we're at a loss year to date on the markets. Towards the end of the year, there was some portfolio rebalancing. Uh, the portfolio managers were selling the winners. Basically, if you, just for an example, if you have a 60-40 allocation, you're a portfolio manager or you're managing money for a client, and you have a 60-40 ratio, just for example, 60% equity, 40% bonds. Over the course of the year, if equity is doing so well, that 60% has became 65, 70%, whatever the scenario is. Therefore, by the end of the year, it required some rebalancing, and that means selling off that equity. So that was part of the contribution towards the end of the year. What should have been the Santa Claus rally was actually a sell-off, and if you want to look at it that way, that was a good reason to have a sell-off because there was such great winnings or gains during the year. However, that's not the only story. The last week, the economic data came in and was showing many inflationary numbers, and this spooked the markets. They're weighing the impact of inflation as to what the Fed's going to do, and they're weighing the impact of potential Trump policies as the inauguration is next week, and they're seeing this all as an inflationary environment. So the number of Fed rate cuts go back a few months ago was perhaps going to be 4 for 2025, and then the expectations were reduced down to 2, and now, I mean, we're looking at maybe 1, or at least the bets are, or the best guesses are, is that there may not be another rate cut. The odds are right now that until September, and then maybe that might be the only one. So this is a higher for longer on the rate scenario theme, and it's in the psyche of the market participants. The other odds on right now is that even there may be 1 rate cut, maybe 2 rate cuts, but there's not going to be more than, say, 25 pip rate cut for the year. That's the best guess right now. That's what the odds are. The odds makers are on this right now. So this is the environment we're looking at, and this is why a combination of all these things is what you're seeing for starting off this new year. Surprisingly, despite the tide going out, I have added actually a few picks to the buy list. A few of the picks that I had on there have actually held up very well during the tide going out environment, which is really a testament to those stocks. It just gives me more confidence with those stocks. But before we get into the major market action, which is what I want to do next, let's cover our disclosure. All right, we do not give financial advice, and this information is not for investment decisions. This is for educational purposes. The stock market is risky, and any trade or investment is expected to have some or total loss. The use of derivatives increases investment risk or potential loss. Do your own research before any trade. Please consult a financial advisor or professional to determine what is a suitable investment profile for you, given your investment goals and objectives. Okay, let's start off with SPY. So as I said, the market's open right now, and you can see even for today, SPY is already down 46 pips coming out of the gate. We're about half hour into trading. QQQ for the NASDAQ is 99 bips, almost a full percentage point down. Dow Jones, a little contrary here, it's up 49 bips. Now, if you recall from past, or just watching this over the last few weeks, Dow Jones has been the real dog of this deal, and now today there seems to be some value in there. But for SPY, what we're looking at is you have, this is the candle for today. This is what's going on today. So it dropped right out of the gate. It's a gap down, but it is fighting its way back up. That's a good sign and something to watch for here. As I mentioned, the high off the highs. So right about here was the high, and that was around what, December 11. So here down to where we are today, right at this moment, we're looking at about a 4.6% decline on SPY. So enough said. I mean, the VWAP's off the high roughly, and everything, all the action is below that. So until that happens, I'm not really giving SPY a green light. And what I do, my interpretation of the overall major markets is greatly influences how deep you want to go into individual stock picks, because obviously we're dealing with the tide here. You can still make money on them. There's some things that are going to move contrary to this, and that's good. But you need to really consider the position size that you're going to get into, and maybe do a little, apply a few more defensive tactics, which I'll get into in a moment. So that's SPY. QQQ, very similar picture right here. This right here is today's action. Gap down open, but it is trying to fight its way back up. Again, I'm looking at that as a good sign, but it really we need to see how it plays out by the end of the day. It's not how you start, it's how you finish, right? So let's look at the high. Again, was around December 16 for this particular market. And as of right now, we're down about 6.5% off that high. So very similar to SPY, and I have anchored VWAP off the high. And as I said previously, I want to see this action get back up above these anchors. Obviously, this dash line is the 50-day moving average. This is the other dash line is the 200-day moving average. The fact that the 50 is above the 200 obviously is good. That is. Excuse me, and now I want this price action to get. It's got to. There's some overhead resistance here so it's going to be a little bit of a battle. But I'm not saying it can't be done, but it's got to go through the 50. The sellers have to take over from these anchored VWAPs off these previous highs, and then this market will be green light, and just part of the overall market sentiment that I'm trying to work with as you look at individual stocks. And then for the Dow Jones Industrial ETF DIA, so here we have it today. Excuse me, it's up. It's up 36 pips right now. This is good for this particular market, although this one has taken the greatest beating. So I guess it stands to reason this is where maybe the investors are seeing the most value. Off the high from December 4th, where are we at? We're at around 6.3% roughly. So although this is looking more encouraging, and at least for this particular day, you can see all the overhead that DIA has. It's underneath the Ichimoku cloud. It's underneath all these anchored VWAPs off these various points, and the high. Et cetera, et cetera. So 50-day moving average. So there is a lot of overhead resistance to overcome here, and we'll just have to keep monitoring it. All of this contributing to my overall sentiment. Excuse me. All right, for major economic news for this week, we have. This is not all of the events. I just filtered this out for the majors, the ones that have the most potential to move the market in the greatest amount. So tomorrow, 8:30 in the morning, is core PPI, producer price index, and PPI month over month. That has potential to impact the market. That'll be watched. Obviously, pretty much all of this is going to have some kind of inflationary impact. Whether it's the upside or the downside, but they're going to be monitored for that reason in this very sensitive environment that we're in right now with risk off and fears of inflation. Wednesday is core CPI, consumer price index. So we have producer price index, consumer price index. Empire State Manufacturing Index comes out on Wednesday. Crude oil inventories could, have an inflationary impact, whether we've built up inventories or depleted inventories. On Thursday, you have the retail sales numbers. Very, very important is to know the consumers out there buying, and if they're buying, are they, does that become inflationary if there's what was the past expression? There's too much consuming going on. Um, Whoops, sorry. Retail sales, unemployment claims on Thursday, Philly Fed Manufacturing Index, and then finally on Friday, building permits come out. So these are the events for the week to watch for. The ones in red are the most significant, and then gold, or whatever you want to call it, is probably second tier for significance for the week here. All right, so here's the buy list updated. So the markets, as I said, they continue to take their hits. So much of this is on hold, but as you can see, I have added a few, and there are a fair amount of buys on this, even in this environment. Affirmed has been on hold, continues to be on hold. It's taken a beating. A couple of weeks ago, this was a $70 stock, and now we're looking at 55 as of the close. This was printed for the close on Friday the 10th. So that was the action. All these numbers here are the results of the up or down for just Friday. So on Friday, that was down 5.73%. Affirmed was. So it's on hold. Chewy's a buy. It's actually on Friday, it made money. That was a bad day on Friday for the market. It made money. Delta Airlines, I had this on my watch list. It obviously, with a 9% pop on Friday, it moved into territory where I now moved it to my buy list. So that's a new entry, Delta Airlines. DoorDash hold, Disney hold, Hood still a buy. It did lose 1.79% on Friday. I could look real quick on what it did today, but regardless, it's still a buy. On is hold. PayPal, this changed. This was previously a buy for me, and because of the recent market action, and at least the action for this particular stock, the price action, I'm moving it to hold. So don't take any new positions with PayPal. If you're in it, that's you just got to manage that position if you're in it. But if you're not in it, don't take any new positions. Roblox, that was an ad from since my last video. So my video was over a week ago, but I added Roblox based on the market activity on January 3rd, Friday. So I added this into the mix, and that is still a buy. Shopify is a hold. Taiwan Semiconductor is a buy. United Airlines, so Delta and United, so you can see the airlines are starting to really have some positive earnings and good news. United Airlines remains a buy. Vertiv Holdings, I believe I had this on hold. These last two, Vistra and Vertiv on hold, but in any case, they're buys now. Last Friday, Vistra had a nice day. Again, that Friday was brutal, but that made money, and even Vertiv, it only had a 26 pip drop. So that's really weathering the storm really well on these. On the bearish side of the tape, so all these strategies, you would take all these tickers right here, you would take a bearish strategy. These are all that they're going down, and I see them going down further, and you can implement strategies that would make money on that, such as buying puts or doing a bear call spread, a vertical spread, bear call spread, or something of that nature where you can make money on the downside. If it's in green, just not to confuse, if it's in green, that means you can action it. So you can action a bearish strategy on AMD. You can action a bearish strategy on Baidu. If it's in yellow, it's on hold. Do not action anything. If you're in it, fine, but and go ahead with your strategy and manage your trade as best you can for what's your acceptable losses and gains on your portfolio. But Abercrombie and Finch is on a hold. Do not implement the bearish strategy if you're not in it already. Celsius Holdings, same thing. First Solar, same thing. All right, so now if you take my bullish strategy list and you just filter this down to just the ones that I have a green light buy for, this is what it looks like. So it takes out all the holds. So we have Chewy, Delta Airlines, Hood, Roblox, Taiwan Semiconductor, United Airlines, Vertiv, and Vistra. I plug these into my option screening filter for covered calls as to where the best value is for covered calls on these. And let's take a look at that. All right, these are the covered calls for those particular stocks plugged into my filter using barcharts.com. Just give them credit. Um, and I basically, these are ones just for the 17th. That's this Friday. So if you're taking a position today or tomorrow, and again, these were prices as of Friday's close. This is not a live pricing. So look at your pricing and make sure it's the same, that it still makes sense. But if you plug in your option screen, taking a look at Vistra or Taiwan Semiconductor or Hood, um, Robinhood. What else we got here? Chewy, United Airlines, etc. These are just for Friday. And basically, let's just go. Oh, and also I've stacked them according to the return just on the premium for selling the call. So Vistra, you buy 100 shares. What was the close on Friday of 166.73? You go out there and you sell a strike, a call. You sell a call at a strike of 177.50, and you're going to get somewhere at least on Friday's information, you're going to get somewhere around $2.14. And what this 1.3% represents that payment. $2.14 times 100, because that's what the option contracts are, is $214 that you're going to get for every 100 shares that you bought. If you bought 200, 300, 400 shares, just multiply that 2, 3, 4x. So your return on that is 1.3% just on the premium alone. And if this did move up to where it hit the strike and got taken away from you by Friday, you have another somewhere between 6 and 6.5% of just pure appreciation or stock gain. And that's basically how it works all the way down the list. All these returns, 1% returns, 1% returns, 90 bips, 80 bips, 80 bips, 70 bips, etc., working down the list here. So these are just for the Friday's contracts. For these contracts that are expiring by Friday, so not bad for say 1 week's work. But you gotta. This is a situation where the market being as volatile and having the negative bias as it does right now, you got to protect yourself on these. With a covered call, the best way to do that is to put a protective put underneath it, which I'll show you on a chart in just a second here. Put a protective put underneath it, and basically what you're implementing is what's known as a collar. So you own the stock long. You sold a call to sell it off if it hits a certain price. That still allows you to have appreciation in the stock, and you make money for selling that call. But you're using some of that money from selling the call, or maybe all of that money from selling the call, to buy protection underneath in case this goes south on you because the tide is going out. And I'll show that on a chart in just a minute here. All right, these are the contracts that are expiring for January 24th, so a week from Friday. So now if you go out 2 weeks, obviously you're going to get a higher premium, right? The time factor, theta, is giving you more time on this, which means the returns, the premiums are higher. So there are some decent returns here for basically what is 2 weeks time frame. United Airlines. Buy 100 shares at 107.11 or whatever it is right now. Sell a strike to have it called away from you at 113. If it gets called away from you at 113, you got a 5.5% gain. And just for selling that contract, you're getting $315, which represents a 3% return just in the premium for the contract. So you have now, if it doesn't get called away from you, that's great. You still get the $315 for your contract, the 3%. And you own the stock still, and you get to do this again after the 24th. I'll emphasize, you need to protect it though. If this goes south, you need to say to yourself, okay, what is my acceptable losses from my risk management scenario? If I'm looking, I don't want anything more than a 10% gain. Let's just say, for an example, it's going to depend on the personality and what the purpose of this account is for you, right? But say 8%, some people will say 5%, 8%, 10%, 15%, some are comfortable with 20, but you need to set up your collar or your protective or your stop loss based on that acceptable risk. All right, let's use one of my recent ads, Delta Airlines, based on Friday, which was this action right here. This candle right here is today's action. So I've always said if you're going to go into a bullish strategy, make sure that the day is starting off positive on it. So I would actually not be buying this right now today until I see, you want it to start off the day as a white candle, a clear candle, not a red candle. So I would not necessarily be buying this today. I'm watching this to buy. But let's just say you went ahead and you're okay with it, just for the purpose of just explaining the collar. So your first, let's see if I can get this to move there. So the first thing you want to do, okay, so you're buying it, right? So now you're going to set up your call, and it doesn't really matter what the call was, but you based on the previous list of long call considerations that I showed you, stock is at 66. So say you had a 70 call. So let's put a horizontal line. Let's make that green, and let's put that somewhere. Let's put that horizontal line at 70, right? Okay. All right. Nope, didn't do it. Sorry. Hold on one second. Horizontal line 70. Make it green. Not a good color. Hold on. Green. There we go. And make it 70. Okay. So now I have. So say that's the call you sold off. Excuse me. So now you know that you're long the stock, and if it gets to that price by the expiration date, whatever one you pick, it could be this Friday, it could be the following Friday, it could be a month from now, whatever option you're considering. And just remember, if you go out further, the longer time you go out, the more premium you're going to get for this. But obviously, the longer you're in the deal, unless you want to sell the stock and you got to buy back the call, because then you have a naked call, and you don't want to get into that. So. So you set up that. Now, the next thing you want to do is pick a price point for the put. Now, you're probably, it's whatever you're comfortable with. So right now, the price action is right here. So say you bought it right here, which is right basically 64.91. And you're saying, okay, I'm okay with 10% loss. Or at least I want to stop the bleeding at 10%. So you're going to be somewhere around that 58.50 price range, somewhere around there. So now knowing that, I'm going to go look at puts that are at 58.50. So let's get a line drawn on this chart. Okay, now this red line down here is where you said, okay, I don't after that I want to have protection after the 10% downward action, which actually turns out to be a pretty good line technically speaking. You have this gap right over here. So this line right here is significant. This is a significant price point. It found support right here. That's significant. And this action right here, this doji with a high bar, showed me that there is some kind of support around that range, just randomly. I mean, I only picked it 10% down, but it also just kind of swerved into a nice technical point with the pricing action. So that seems to be a good spot to maybe put your stop loss. So if you own the stock outright, you can do a stop loss, and stop loss is free. You just tell, you put the instructions in to say, hey, if it hits this price, which is 58.50, sell it. You're telling your brokerage, just sell it. I'm out. But what you can do, where you have more control over it, is I said, the premium that you get for selling the call, you use to buy the put, and so therefore, it does reduce your returns, obviously, on your premium, and it may even erase your premium returns on the call side for selling the call. But you now have a scenario where from price appreciation, you're gonna make money if it goes up and crosses that price point, right? And you're protected on the downside. So it doesn't matter if this goes it doesn't matter that this goes down to $50 or whatever, because you can always put it to somebody at 58.50 by buying that put right there. That's your protection. Now, the expiration date on the put, You may want to go out. You definitely want to go out as long as you have the call. So the call, if you bought a call for say just expires January 24th, you want your put protection there. If you try to go out further with the put protection, which you can, because you may own the stock longer than that. In other words, that call could expire. This price action could go sideways, and then you never get called out. But you want to write another call, but now you got to buy another put, which is fine. You can do that, but also if you buy a put that's longer than 2 weeks in anticipation of holding it longer, you just remember you will pay more because that's further out in time. That's theta. So theta is going to contribute to the price. More time is going to mean a higher price on it. So it's kind of your comfort level on this. Typically, what we do for callers is this protection is going to be in place as long as the covered call is out there. So they kind of go hand in hand. So if I bought my covered call, if I bought DAL Delta Airlines, bought this and then put the covered call adding at 70, okay, fine, you can take it away from me at 70. I'm going to use the money that I got for selling that 70 to go off and buy my put. I'm protected at 58.50 on the downside. And here's the beautiful thing. Even if this did go below 58.50 and you're protected on the downside, it doesn't mean you have to sell. If it expires in the money, which means lower than this point, lower than the 58.50 on the expiration date, it will be assigned, and the brokerage does that automatically. So you want to manage this, that if for some reason, whatever, you feel that, yeah, it got below 58.50, but you know what? I got some confidence in this, and I still want to stay with it. I don't want to put it to somebody. You can just buy back that put and roll it out lower, pick another price lower, depending on what your analysis is of the situation at the time. But I only emphasize that because it gives you control over the selling of that. So if you put a stop loss in, it's going to be implemented. It's in the system. It's automatic. As soon as the price hits, it becomes a live market order, and then it's filled. And you don't really have a say on that. And what could happen is this thing could just come down and have one bad day at the opening. It's kind of like one of these flash crash deals, and the price action comes all the way down to here. Your stop loss is triggered, but by within an hour, all the action came back up, and it just was like this momentary flash crash, and you just hit your stop loss, and you're like, oh man, I didn't want to get out of this. Oh, so although the put costs money, buying the put gives you the control. That doesn't mean it gets exercised if it goes down below the price point. So that's why having that collar, meaning it's sold out for a profit, protected on the downside, is really a beautiful scenario, especially in this current environment where you need to be a little more defensive. All right. Okay, so that's it for today. If you have questions or you need to reach me, my email is mark@simplicityIW.com. Thank you for your interest, and thank you for your time in watching this. Please click on subscribe if you haven't. And once again, thank you. And remember, keeping things simple is really smart. Everybody, have a great day. Take care. Bye-bye.